Okay, we're now going to look at capital accounts for partnerships. Capital accounts are going to always pretty much have a brought down on the credit side because it essentially represents the value that's owed from the business to the owner of the business, the partner in the business. So it's seen as, or it can be seen as, a very long-term liability of the business to someone who's obviously invested money early on. Now we're going to look at a few things. When there is a change in partnership, that basically means that a partner joins or leaves or dies, then we're going to have some impact upon the capital accounts for the partners. So that's when we do something to the capital account, is when there's something called a change in partnership. Somebody joins or leaves or dies, then we have to do some adjustments to the capital accounts. Okay, so we've got a few things that we're going to deal with. We imagine that there's 3 assets that have been revalued. Now some of those assets, non-current assets, might go up in value, some will go down, but the overall value, change in value, we're going to assume out of those 3 changes is an increase in value of 60,000. There's goodwill that we've decided, the business has decided, is worth 90,000. The partner will introduce additional capital of 10,000. There's 3 old partners, partner A, B and C. We're just looking at partner A's capital account here, but obviously there is, and we could look at partner B and C's capital account. Some parts will be similar, some will be slightly different. And partner C is leaving, so after partner C leaves, we're going to have 2 remaining partners, the new partners we'll call it, is going to be A and B, and they're going to share profits 2-to-1 ratio. The old partners agreed to share profits equally, 1-1-1. Okay, so considering that's the case, we're going to look at a quick example of how we go through this. Obviously, for a more detailed look, go to my longer video series in the link. Okay, so now we're going to look at, let's do the revaluation first. Again, we could go into a little bit more detail, but overall, we're saying that non-current assets have been revalued and there's an overall increase in value of 60,000. So if we had a revaluation account, we're going to have a value of 60,000 on that account, and that 60,000 is going to be shared to the partners. Now, in the old ratio. So the old ratio is this. Okay, so the old ratio is that all the partners shared profits or gains or losses equally. So this 60,000, which is an increase in the value of non-current assets. And why is it there? Well, if we increase the value of non-current assets, we would be putting a 60 on the debit side or left. So if we debit this account, credit that account, that obviously we have to have a debit for every equal credit. So we're doing that. Now, the revaluation account is a calculation account, and therefore it should not have a balance to carry down. So therefore we need to distribute this 60,000 to the partners in the old profit sharing ratio, which is equal. Now therefore this equally between 3 partners is 20, 20 and 20, and that's going to go to partner A, B and C. So for partner A, which is what we're doing, in the revaluation, remember we have just debited this account with 20, revaluation account, so we're going to credit partner A's capital account with 20. And we would do the same for partner B's capital account, partner C's capital account. So that's the revaluation account done, so we can get rid of that account. If you had to do a revaluation account, that's what it would look like before I crossed it out. And then, so that's always done in the old profit sharing ratio, which is, in this case, equal. And it would always go, if there's an increase in value of assets, it would go on the credit side of the capital account in the old ratio. If there was a decrease in the value of assets overall, the revaluation would go on the debit side of the capital account at the end, still in the old ratio. Now we're going to do goodwill. We introduce goodwill, that's decided as 90,000. So 90,000 is introduced into the credit side of the partner's capital accounts in, again, the old ratio. And then, so as we introduce on the credit side, we will introduce it on the debit side of the goodwill account. We're introducing 90,000, okay, in the goodwill account. Now, that as we do that, we are crediting the capital account. So the capital account we're going to credit as old ratio. Again, it says that there in the old ratio. So 90,000 split equally into 3 is going to be 30 and 30 and 30. So now that what we're going to do, so if we have debited the goodwill account and credited each partner's capital account, and so it's going to be, or we could sort of write this out as individual figures, 30 introduced, 30 introduced, and 30 introduced for A, B, and C. So essentially 90 introduced overall on the debit side of goodwill, 90 introduced on the credit side of the capital accounts for all three partners in the old ratio. But the overall value was 90. Now we need to write off the goodwill. So goodwill is always introduced on the credit side, and that is in the old ratio, and it's written off on the debit side or the left hand side in the new ratio. Okay, now the new ratio is after a partner has, if we're doing a partnership change where partners joining, the new ratio will be with the new partner, and if we're doing a partnership change where some partner is leaving, the new ratio will be with the remaining partners. In this case, we have three partners, one is leaving, partner C is leaving, the new partnership relationship will only be with partner A and B, so the new partnership profit sharing ratio is partner A gets 2 parts, and partner B would get 1 part of any change. Okay, so in this case, the goodwill is 90,000. We need to get rid of the goodwill, so we introduced it here on the debit side as 90,000. We need to get rid of it on the other side in this ratio. So if we divide 90,000 by 3 parts, give 2 to A, that means that A will get 2 parts of 30, which is to partner A, which is 60, and partner B will get the 1 part, which is 30, to partner B. Okay, so we are now crediting the goodwill account with 60 and 30. Now we're going to debit the capital accounts with 60 for A and 30 for B. So for A, which is what we're doing, we're going to get rid of 60, so debit 60, credit 60. Okay, and for partner B's capital account, we would debit 30, and because we're crediting 30 there. Now this account is also cleared off. Okay, so we've done the goodwill introduced in the old ratio, the same 90,000 goodwill written off in the new ratio, and then pretty much we're almost there. Now, the other two things that may happen is if it's a partner who's remaining in the business, so not partner C in this case, one of the other partners who are staying, they might introduce more capital, so additional capital. If they do that, then essentially that capital or money is going to go into the bank on the debit side, and we would credit their capital account. So credit capital, debit bank, if the partner is introducing more capital. But if the partner is leaving, and in the case of C, partner C, if they're leaving, we would need to pay them some money. So in that case, we would be crediting the bank with whatever cash we owe to partner C and debiting their capital account, and we would just write bank next to that, so that their capital account does not have a value remaining as a balance to carry down. Because if they're leaving, they don't want to have a balance on their capital account, because the capital account balance means they are still a partner. If they're leaving, they don't want to be a partner. So whatever we owe them from the credit side, we'd add that up and pay out anything we need to on the debit side of their capital account, take it out of the bank, the business bank account, and therefore they will have no balance to carry down. Now this partner is not leaving, so we would balance this account off. So what do we have? We have 100 and 20 and 30 and 10, so that's 160 as a balance on this side, 160, so as a total, and we put the same total on the debit side. Okay, so 160, 160, and then we find the missing number on the smaller side. This is the smaller side. We only have a value of 60 here. The total is 160. We take away the 60. The missing number is 100,000. So partner A has a value or balance on their capital account at the end of the year of 100,000. That would be then brought down after or under the totals on the opposite side as a balance brought down of 100 on the opposite side as the balance to start next accounting period with. So the capital account has a balance of 100,000 at the end of this year, and therefore at the beginning of next year. And so that's a quick look at capital accounts. I do run through this in more detail in some videos that are in the link below.